choose to take on those kind of loans. I think this is a painful lesson for the industry, but just crossed the threshold of 20,000 crypto tokens. And so there's one that's clearly a commodity, and there's 20,000 tokens, most of which are securities. And the entire future of Bitcoin is, for better or for worse, it's linked with the crypto industry. So the sooner that rationale and order comes to the crypto economy and the crypto industry, then the better it's going to be for Bitcoin, and the sooner that Bitcoin will emerge as a mature institutional treasury reserve asset. Bitcoiners forever have been saying, not your keys, not your coin. And they say, get your Bitcoin off the exchanges. So, I mean, the essential thing that you want to do after you acquire Bitcoin is to store it in a safe place. Now, that safe place isn't always a hardware wallet. It might be an organization like Fidelity that's a custodian that you trust, or some cold storage, or some institutional grade custodian, or a multi-sig arrangement with a company that you vetted, you trust. But leaving Bitcoin on an exchange has always been risky since Mt. Gox. So we all learned that. And I think that borrowing or generating yield from a unregistered or unlicensed bank or an immature bank is a risky thing to do. And so, for example, MicroStrategy, we took a loan from Silvergate, but Silvergate was an FDIC insured bank. And when we did that, the terms of the loan were such that we didn't transfer our Bitcoin to Silvergate Bank. We actually put it in custody, and we maintained custody of it. So we could have borrowed money at 0% interest if we had transferred the Bitcoin to one of these wildcat crypto banks, where they would say they give you a very, very cheap loan at a high loan to value, but the catch is you have to transfer your Bitcoin to them, and then they loan it out to a third party. The challenge with that is that you take the counterparty risk with the bank. If the bank fails, then you lose your Bitcoin. And then you also take the counterparty risk with the counterparties of the bank that you don't know of. And so if they loan it to someone else, to a hedge fund like Three Arrows, and the hedge fund fails, then you also lose your Bitcoin. So you're actually taking two layers of counterparty risk to do business with an immature bank. It always looks good going in. They pay you a higher interest rate, or they give you a cheaper loan. But the counterparty risk, when you calculate it, offsets the benefit. That's why we've never done those things. That's why we never generated yield on Bitcoin. And that's why we didn't choose to take on those kind of loans. I think this is a painful lesson for the industry, but it's not a surprise. I think for the business to grow up, we need more mature, better capitalized institutions, publicly traded companies, public banks, FDIC insured banks, right, licensed, registered entities. And of course, when you're doing business, what you want to do is always be careful when it looks too good to be true, right? Because when it looks too good to be true, generally it is.
What do you think is Bitcoin's biggest vulnerability right now?
I think that right now, the biggest vulnerability to Bitcoin is the rest of the crypto industry. I think the 20,000 tokens that are unregistered securities. I think the crypto exchanges, the wildcat crypto banks, all the crypto projects, all of the people trading those cryptos, all the crypto hedge funds, and then all of the negative publicity and then the negative financial outcomes that come about from things like Terra, Luna, right? The meltdown of a stable coin that was not stable, that was traded as a commodity that was really a security, that because they never declared it a security, they never actually made any fair disclosures on it. So you had an under collateralized asset, $50 billion worth of something trading with $1 billion or $2 billion of equity, right? 50x levered without disclosure, with a lot of DeFi exchanges and other crypto exchanges allowing those tokens to trade and marketing them with leverage. And I think that got cross collateralized into Bitcoin. And so the volatility of Bitcoin on the upside and the downside, and then the negative publicity and the fear that a conventional investor, an institutional investor would have to buy Bitcoin is in large part due to the Wild West and the wildcatters and the crypto ecosystem. And the sooner that we clear out that leverage, and the sooner that the world starts to distinguish between crypto tokens that are securities and then Bitcoin, which is a commodity, then the sooner the industry grows up and the asset class grows up.
That's right. Do you have any concerns about solvency with Bitcoin miners? I know that a lot of them have financed their operations through debt. Do you worry that any are over leveraged?
Well, the elegance of the Bitcoin protocol is that Bitcoin mining is an open, permissionless industry that anybody can join. And every 2 weeks, the difficulty of mining increases or decreases based upon the market dynamic. So I think of Bitcoin miners as the line of first defense for Bitcoin. When things go badly, either when poor decisions are made, or when acts of God take place, or acts of government or nation states, the miners suffer so that the Bitcoin holders don't. So do I worry about miners? Sure. If you're a miner in Iran running on free energy, when the government cracks down on the free energy supplement, you'll suffer. If you're a miner in China running on free or cheap electricity, when the government starts to notice that, you'll suffer. So miners will suffer. When electricity costs go up, the miners will suffer. When the Bitcoin price goes up, they'll benefit. Over time, mining is going to get more difficult. It's going to get 18% more difficult every year because of the halvings. Mm-hmm. And it's going to get 50% more difficult every year because, or 75% more, or some percent more, because hash rate keeps coming online. And if you're entering the mining business, you're entering into a very, very competitive industry. So that's why I think it's better, if you have money to invest, it's better to invest the money in Bitcoin, not in a Bitcoin mining rig. I think Bitcoin mining is a business and there are counterparty risk. We've seen, for example, if you had mining rigs in Russia, when the Russian sanctions took place, you lost your mining rigs. Okay, so if you're in business, you can have your business interest damaged by war, famine, tariff, tax, competition, entropy, poor execution. And that's why mining Bitcoin is not the same as holding Bitcoin. It's a very competitive, challenging thing. But if miners on the periphery go out of business, when half the hash rate got wiped out in China, it didn't damage Bitcoin. It simply shifted the profitability to North America. And if Bitcoin prices get cut in half, and if electricity rates double, it won't wipe out Bitcoin mining. It will simply squeeze out people running mining rigs that are previous to S9. The third generation antiquated mining rigs will find their break-even point reaches 1 or 2 cents, a kilowatt hour. And if they can't buy electricity cheaper than a penny a kilowatt hour, they're not going to be profitable. So they'll shut down their hash rate. But when they shut down the hash rate, the difficulty will adjust down in order to balance the network. And the network is probably 1,000 times higher hash rate than it needs to be secure. So I don't really worry one way or the other about Bitcoin. And as for Bitcoin miners, yeah, if I would worry about every one of them. And the reason I don't run a Bitcoin mining company is because it would take all my time and all my attention, and I would be worrying about all of these